Hey everybody, and welcome back to Investing with Wesley. If you remember my previous episode, I explained to you why growth stocks and tech stocks and everything in the growth sector is just tanking recently. And if you've been paying attention, you might have noticed that a lot of popular cryptocurrencies like Bitcoin and Ethereum, they're tanking as well, except they're not necessarily related to the growth industry, so what gives? Well, in today's episode, I want to explain to you exactly what's happening in the crypto market so that you could better prepare yourself and maybe capture in and buy the dip. Let's get into it. Okay, so crypto like Bitcoin and Ethereum are starting to take a beating and they're down a lot. So what gives? And in my opinion, there's three different things that could be leading to this. And I could be right on all of them, or only one of them, two of them could be totally wrong. Who really knows? But my theories are as this. The first one is that all of the restrictions and crackdowns on mining for Bitcoin. It made headlines last year and in 2020 that China was going to outlaw and ban all sorts of mining and crypto operations, and now recent headlines say that Russia plans on doing the same. So with more and more countries banning the use and the mining of this cryptocurrency, that could be leading to it going down. Now my next theory is simply the market as a whole and margin calls. If you're unfamiliar, margin is when you use debt to invest and double down on your position. And whatever brokerage you're using to invest as well as use this margin will typically do margin calls, one at the beginning of every year, as well as when there's a significant downturn in a lot of stocks. Banks and brokers won't want to risk their money, so they're going to ask you for their money back and ask you to close your positions. Well, a lot of smart investors won't want to close their positions on their stocks that they're receiving dividends that they live off of, as well as they're not going to want to sell for a loss. So instead, the money that they've been putting into these cryptocurrencies, they'll pull out and pay back margin. We saw this happen during the 2020 crash as well. A lot of margin calls were triggered and the crypto market took a dip as well. Or my final thought is that it's the exact same reason that growth and tech stocks are falling as well. Now, the main reason that growth and tech stocks are falling is because interest rates are rising and it's causing a massive devaluation of all these growth companies. Now, interest rates don't directly affect the crypto market, so how could it possibly be the same issue? And you're 110% correct in thinking that. Interest rates do not directly affect the cryptocurrency market. However, they do indirectly affect it. And how they indirectly affect it is simply through you and the psychology of investing. So we already know that as rates increase, the growth sector decreases because the increased debt prices eat away at the cash flow and eat away at the valuations, causing that sector to fall. But part of the psychology of investing is getting inside the mind of the investor. And doing that tells us that as bond yields go up with the expectation that interest rates are going up as well, it makes the growth and tech sector look less appealing because whenever risk-free investments begin to give greater returns, the more riskier investments begin to look less appealing. And to help you understand it better, there was a study recently done, and I'll put a link to the article down in the description. But a study was done splitting investors into two different categories. There was Group 1 and Group 2. Group 1 had to consider the investment choice between a risk-free 5% and a risky 10%, and they had to choose which one they would rather go to. Whereas Group 2 had to choose between a risk-free 1% and a risky 6%. If you notice, in both scenarios, the gain is exactly the same. The gain is equal 5%, from 5 to 10 or from 1 to 6. Either way, the investors choosing the more risky option are only getting 5%. So you might be thinking to yourself, because the risk to reward is the exact same, the results are pretty much going to be 50-50. But you would be incredibly mistaken. The results actually showed that as the risk-free investment got lower and lower on percentage, the amount of investors willing to choose the more risky option grew drastically. And as the risk-free investment went to 10% or greater, the vast majority of investors chose to stick to the risk-free investment and not choose that more risky investment. In other words, low risk-free returns caused drastically more risky investors. This study confirmed two different psychological theories when it comes to investing. The first one is that investors form a reference point on what they think they should earn from any given investment. And as interest rates drop below that baseline that people generate for themselves, they decide to move further and further into risky investments to try and earn what their frame of reference is. The second thing that this study confirmed is that if risky investments paid substantially higher returns, then people are more apt to go for those risky investments. Breaking down the same study and the same options I told you earlier, the difference from 5% to 10% is 100% you double your money. However, the difference between 1% and 6% is 500 times where you started. So even though 10% is a greater return overall between all of your options, people are more likely to choose the riskier option in lower interest rate environments simply because they're hoping it produces a 5x or more return. So really, when you think about this, what does all that mean? And I think it's a combination of all three of these theories that I've just laid out for you. I think all three of these theories I've just laid out for you are all true in their own right. I think initially the growth sector fell due to the increase of interest rates, which is causing a margin call and having people sell out of their crypto. I also think that people are more averse at risky investments since they're getting slightly greater returns on their risk-free investments. Even though when you really think about it, the risk-free portion that's going up is only fractions of a percent. Either way, though, the study shows that the psychology of investing and these theories are 100% true. And lastly, I think people are more apt to switch from their risky investment to this risk-free investment because of all the headlines and news that is Bitcoin and Ethereum, and all these other countries blocking and banning the mining and use of these cryptos. I think in total, all three of these things are causing people to massively sell off of their crypto and switching to buy the safer investment of the US stock market. But it really doesn't matter what other people are doing. What should you do? What does all this mean and how does it directly affect you? Well, I am a strong proponent that both Ethereum and Bitcoin are great storeholds of value. There's much more utility use in Ethereum than there is Bitcoin, but Bitcoin is basically digital gold. If you think it's a smart idea to invest in the commodity of gold, then you would also think it's a smart idea to invest in Bitcoin. Both growth stocks and cryptocurrencies are currently dipping rapidly. And if you have spare cash lying around, I would highly suggest that you buy either dip because Bitcoin is deflationary by nature, meaning whatever money you give it now, it'll become more valuable in the future. And I could see Bitcoin giving a 10x from its previous high by the end of next year. So definitely buy now while it's basically half off. And the same thing goes with the tech and growth companies that are currently dipping. Take Netflix for an example. It is a great company with great financials, but it is currently slumping. And in my opinion, it's just giving you an opportunity to buy the dip when everything's on sale. And if you've been watching this channel for a while now and you've actually been taking my advice, most of your portfolio should be in value, good dividend producing stocks. And whatever cash flow and dividends you're receiving from these companies every month, you should turn around and invest the dip, as well as any free cash flow that you might have from your jobs or side hustles. So there you have it, why I think the crypto markets are dipping and what I think you should personally do about it. I hope you got value in this video. If you did, please remember to like and subscribe as it really helps this channel get out there. I have a dedicated Facebook and Instagram account, so if you ever had any questions or comments, you could go ahead and send me a message there. Either way, though, the choice is yours, and I'll see you in the next episode.